itself. Sanjay Mookim is a strategist, head of India equity research at JP Morgan. Sanjay, great to have you with us here. Thank you very much for your time. Prashant this side. Let's just start, Sanjay, with your near to medium term expectations from this market, given all that is going on.
Morning, Prashant. It's good to be on. Well, of course, this has become a very macro market, and India, as I argued in one of my notes recently, we've kind of given up all the premiums we'd earned in 2022 over the S&P or over, let's say, EM, so in relative valuation terms. So India is now back in line with averages to the rest of the world. However, the near-term outlook, Prashant, will depend a lot on what happens to the rest of the world. And to put it in a very sort of, oft-used caricature, whether we get a soft landing to the global monetary situation and economies, or we get a hard landing or not, is the big debate ongoing in markets. Currently people are worried about the potential for a hard landing, some sort of a crisis somewhere, forcing huge cuts to either EPS and valuation. But if the view changes that tomorrow that, look, you're going to get a soft landing instead, because we hear from the Fed, we hear from policymakers that they're going to manage the situation and confidence starts to improve, then maybe India participates in a little bit of a tactical bounce in the near term. So while you're living in the moment, it appears very uncertain and binary. But the good news for India is that we've, in this process, eradicated all the premiums we had over the last few quarters.
All right. Hi, Sanjay. Good morning. As you said, with the recent underperformance, valuations have become a little bit more favorable, from those elevated premium levels, though we are still at a premium in comparison to the globe. How would you approach the Indian markets, though? Stick to the larger cap names? I recall when we last chatted, you were saying you would still be a little bit wary about the broader market, some of those smaller names in the Indian markets. Is that the strategy you still adopt?
It is. And in such sort of uncertain situations, we've always tended to lag and wait for clarity before jumping in, because you are in a slightly more of a capital preservation mode right now. We've been defensive in our portfolio allocation for quite a while, in overweight staples and stuff like that. And I'd stay that way. I'm happy missing the first 5-10% of a recovery, if the Fed comes out dovish tomorrow and tells us everything's fine, and act in response to policy action rather than anticipation of it. Because even today, despite the fact that valuations have become a little bit more comfortable, the potential downsides are still fairly large, right? If you take it down to where the S&P could be on a lower PE or with EPS cuts, there could still be large cuts to asset prices, and we don't want to act ahead of that clarity.
Sanjay, I think you put out a note sometime back looking at these sort of average valuations and how one should read them, right? Just explain that. I mean, it was an interesting point. I looked at on Friday, last Friday at close, Nifty 1 year forward P multiple, that was about 17.3. The last 10-year average is about 17. So we're not very far. Of course, now that's a moving number based on earnings and, the P multiples themselves. So just a little bit of sort of explanation on how you think about these comparison now to averages and what's the right way to do it.
Well, my note was provocatively titled, "There is no average PE in India." And the argument there is that if you look for most stocks, and actually for the index as well, the multiples have trended up over the last 15 odd years. I mean, the Nifty has gone from a post-GFC low of 12 to as high as 22 during COVID. And this was driven by expectations of slightly better growth, lower cost of capital, and more importantly, a reduction in equity volatility. So lower volatility meant that equity was perceived as a lower risk asset, which drove the multiple re-rating. All of these situations have changed. And the point I was making in my note is that while the multiple today looks like where it was in 2018 or 2019 for the Nifty, adjusted for growth expectations, the cost of capital, and for the increase in equity volatility, I mean, it's a riskier asset class now than it used to be, markets do not fit, or equities do not fit a DCF just yet, right, in general. So you cannot say that, look, just because it looks lower on the chart, it has become cheap relative to the bond market or relative to growth expectations and so on. If you then do that exercise bottom up and do it individually for stocks, the only sectors that fit that DCF today are banks and parts of the industrial complex, the industrial sectors in India.
Sanjay, if we're talking about banks, will you stick to the large private names, or do you believe some of these PSU banks as well, which have seen a sharper correction after a big outperformance in 2022, would you be looking at them?
At the moment, we stay with the large private banks, and even within the PSUs, the top larger PSUs as such. What we don't want to do at the moment is take lower size, lower beta risks, because the factor that we always forget in cycles is liquidity issues. For investors such as ours, we don't want them to be caught in illiquid situations. We are seeing market liquidity fall, participation in the smaller stocks is reducing, and therefore it is inadvisable to my mind to jump ahead and buy a situation that you cannot then eventually get out of. So again, to kind of reiterate what I said earlier, I'd rather wait for clarity and wait for a view forming on the hard versus soft landing before taking liquidity risks in my portfolio. Therefore, large cap stocks is something that we clearly favor in our portfolios.
Okay, all right. And Sanjay, you said also you've been more defensive, right? Staples, case in point. But what about discretionary names? You stay away from them?
Yes. Now, let me caveat that a bit. On the margin, things have started to look a little bit better for the Indian consumer, and this is driven by two factors. One, oil prices, gas prices, coal prices have come off, and they've come off sharply in the last 5 or 10 days. And this actually, on the margin, is good for disposable income. Inflation will fall, companies' margins could go up, or companies' volumes should go up if the commodity complex stays this way. If you take a 20 plus year history of Indian markets, relative performance to EM is driven by oil. So when oil goes down, India tends to do better in the EM complex. But fundamentally, it is good for the Indian consumer as well. We did a note a few days ago tracking the job situation in India, and we get a lot of data from the NSSO surveys. And what that also says, that in the December quarter, in December 2022, total salaried and wage jobs in India are estimated to have gotten back to where they were in 2019, pre-pandemic. So we were in a big hole in terms of salaried and wage jobs all through 21 and 22, but we now closed that as well. So consumer confidence on the margin should continue to improve as the employment situation is getting better and as inflation recedes or commodity prices recede. The only catch for the consumer discretionary is that the multiples still remain punchy, especially relative to elevated bond yields. So if I do get, let's say, something cheap enough, on the margin, you would probably look for a slightly positive medium-term view on the consumer space in India.
Right now, Sanjay, in the markets, IT is the one which is selling off. The index itself is down 0.75%, even as the Nifty is up about 0.33% or so. The Nifty IT index is what I'm talking about. Infosys, TCS are losers. Persistent, Tech Mahindra, Coforge. Actually, mid-cap IT is doing. Emphasis is selling off harder as compared to large caps. IT services, Sanjay, what's the view now?
We have been cautious for a while, and we continue to remain with that sort of an outlook. And the reason is this is very vulnerable to developments in global banks. It's a proxy in the Indian market to the BFSI space, as we know. And more importantly, these stocks, despite the underperformance, are still trading at small premiums to where they were in 2019. And IT actually, even though I argued that there is no average PE, for Indian IT stocks, the multiples have been relatively stable. So for them to trade at a premium is a little bit of a disconnect. Then we have the 4Q results coming up, in which we expect the companies to provide guidance. And there is risk that the companies are cautious in their guidance and come in at the lower end of expectations, possibly, given what has recently happened in global banks.
Right. Sanjay, just one last question from my side before we wrap things up. Just a quick take on growth itself. You talk about formal jobs and how they're back at 2019 levels. What's your assessment, for companies under your coverage? Is demand likely to remain stronger as things stand right now? Is it structurally getting a little weaker? What are you seeing out there?
So there's a glass half full, half empty answer to that question. The half empty answer is that the output gap in India remains significantly negative, which means that the economy is still operating well below capacity. The last RBI update indicated that there is a significant gap still. The half full answer is that the economy is slowly closing that gap. We can see quarter after quarter levels of activity continue to pick up. It's coming in a bit slower than expectations. We're seeing GDP misses and GDP downgrades quarter after quarter. But on trend, it is starting to close. it will take a while before we fully close that gap into my mind. And therefore, the expectations of a very strong 7-8% GDP growth, which is somehow seem to be the base case in India, those seem a bit aggressive. Our forecast for growth next year is 5%. We think it will come in below expectations in FY24.
Right, Sanjay, good speaking with you. Thank you very much. So it's going to be slow. Don't expect things to pick up or have high expectations, low expectations. I mean, I think that's the answer here. Thank you very much, Sanjay. It's always a pleasure speaking with you. By the way, the markets basically come back to the day